Right, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today it's my absolute pleasure to bring to you the updated Boingo wireless analysis. And so, what I've been doing is I've been working away, just trying to reverse engineer, as you guys may recall from my previous video, the MTA deal, and then use the commercials to try and understand what the benefit to Boingo will be, and then also work out what I believe the average deal is worth to Boingo, and then use that to project the remainder of the 2019 revenue and EBITDA, and also 2020 to arrive at what I think is a fair valuation for the company. So guys, I really hope you enjoyed the video. It's been a lot of blood and sweat in the making, so if you're getting some value out of this, make sure to smash that like button, leave a comment, and share the video, and let me know what you might like to see next. Following on from last time, you may recall that in my previous analysis I said, look, I think the catalyst for the share price and the sentiment to take a reversal will come in Q3, but most probably in Q4 in terms of the earnings calls. So as you guys may recall, I've reversed engineered the MTA deal in terms of the commercials. I'm going to work out what I believe the contribution to Boingo is, project the Q3 and Q4 numbers, but more importantly, project the FY20 numbers, which will then allow us to arrive at an exit EV to EBITDA multiple based on the past performance of the stock, and also applying a level of conservatism, and then basically that'll then allow us to conclude with what I believe is the target upside valuation for the company. So now you guys might be wondering, okay, well, what multiples should we assign to Boingo? And what I've done is I've done a bit of digging, and the answer to that question, so I'm going to use two sources, okay? So on the first source, as you can see over here, this is a Guru Focus, I guess, EV to EBITDA historical valuation for the company. And as you can see, the minimum's been about 4.2, the maximum has been about 26.3, and currently it's 7.19. Okay, so that includes when it first listed, pessimism, doubt, all of that, all the way through to when it was trading at all-time highs, and then sort of back to the depressed valuation today. However, what we're going to use is not this, even though the median is about 13. I think that's still a little bit too high. So what I've also done is I've gone to Seeking Alpha. So as you guys can see towards the bottom right-hand corner of the screen, the trailing EV to EBITDA multiple has been 16.7, but the forward EV to EBITDA multiple has been 10.52 on a 5-year average basis. So in terms of conservatism, I'm probably going to use the lower end, i.e. the 10.52, and project it up to a maximum of about 13 and a half, but no more than that, in terms of understanding what the appropriate EV to EBITDA multiple should be. So that's the first part. Okay. Now the second part, what we're going to do is we're going to use some of the information that we know, which is, for example, from their investor presentation. You can see that in terms of their DAS revenue, 2/3 of that is the build fees, and then 1/3 of that is the recurring access fees. Okay, so this is information that we're going to use. Second of all, what I've done is I've got you a couple of extracts from the MTA RFP and the commercials of the deal. Okay, so what we know is that whilst as a whole the average deal length for Boingo is 5 years to 20 years, we have some specifics with the MTA deal, which will then allow us to project and reverse engineer the actual revenue and EBITDA benefit. Okay, guys, so the first part of the MTA deal, 10 years initial term, 2 renewals at 5 years per renewal. The second part is 15 years initial term with 2 renewals at 5 years per renewal. What I've also done is I've also collected what you can call as the revenue share, or the compensation that Boingo will pay the MTA. Okay, guys? So this is something that we have to be very conscious of. Boingo doesn't make money from the MTA for the deal. Boingo leases the venues from the MTA and pays them a fee then makes money from the carriers who want to access Boingo's network. Okay, guys, so this is a very important distinction we have to make, okay? Boingo is going to be paying the MTA because the carriers are going to be paying Boingo. So keep that in mind, all right? So why is this important? Well, you guys can see over here, the MTA expects their net present value of the total compensation of the initial term of the deal to be X dollars, as you can see highlighted in yellow, okay? We also know that they've got an annual adjustment to try and either match or exceed CPI, inflation. And we also know what their revenue share percentage is, for the different, the different types of services, okay? So this is part one of the deal. Part two of the deal, we also have these numbers, okay? So you guys might be wondering, well, why is this important and what does this mean? Because effectively, this will allow us to then reverse engineer what the whole deal is worth, which will then allow us to arrive at an annual value, right? So that's the total value that Boingo gets paid. Now, obviously, they're going to pay some of that off to the MTA. That's cool, but then we'll understand roughly what the actual deal is worth to Boingo, right? Then we can then apply the revenue growth rates, margins, whatnot, okay? So you guys can probably see where I'm going with this. Okay, so the second part of the deal, as you can see, the commercials are all on the page, and their annual CPI adjustment is 3% rather than 2%. So this is all information that I'm going to take into consideration for my calculations later on, which you'll see in the video. All right, moving on, guys. So at this point, you might be wondering, well, okay, well, that's cool. So then how do we reverse engineer what year one of the deal is worth if we only know, what the net present value of the total deal is worth? And also, how do they arrive at a discount rate, okay? Now, the discount rate that I've used is 12%, because I'm quite conservative. Now, thinking about governments and whatnot, they're very good at wasting money, so it's probably not going to be 12%, all right, guys? So that's why you should probably, if you want to work it out for yourselves, do your own sort of calculations, okay? So I'm just going to give you the frameworks of what I used, and then you guys can sort of play around with the formulas, okay? So in order to reverse engineer what year one of the deal is worth, you sort of have to reverse engineer what each year is worth and then apply that discount rate, then bring it back in time. It's all really complicated. So what I've done is I've got somebody who's a lot better at math than myself to create this rough table for me, right? Based on the table above, what I believe year one's revenue for Boingo to be will be the total amount divided by 6.0126, okay? Now, again, that's based on a 12% discount rate. If it was, say, 7% or 5%, that'll be different, okay, guys? So really have a go at working out this yourselves, okay? Now we know what we think year one is. Like, how do we put this all together and how do we project this, okay? So what I'm going to do, guys, is I'm going to show you the inner workings of the spreadsheet that I use. And again, just a disclaimer, I failed math in high school, so take that with a grain of salt, build your own and work it out, okay, if you want a bit more confidence, all right? Okay, guys, as you can see, we've arrived at the spreadsheet. Now, before I get into the actual calculations, I actually wanted to run you through exactly what I'm going to use and how I'm going to calculate it, okay? Because the MTA deal is only one portion of Boingo's business, okay? That's the DAS business. But they've got military, they've got retail, they've got multifamily, they've got wholesale, they've got advertising, they've got the whole lot, okay? So how do we put all this together, and then how do we arrive at the FY19 quarter 3 and quarter 4 numbers, but more importantly, the FY20 numbers, okay? So what I've done is, as you can see on the spreadsheet, this is a full track record of their revenue change from quarter to quarter, and also comparable quarter year on year per segment, okay? So you can see I've got it all there. I've got the DAS, I've got, military, I've got all their segments, okay? And you can see how it's changing, right? So this is the trend. All right, guys, and the thing is, we're not going to spend too much time on each line item because, like I said, if you really want to get into the depths of it, I'd recommend building your own spreadsheet. But as you can see here, we've actually got a pattern of how the revenue changes quarter on quarter and year on year over time per segment, okay? So some of the things immediately visible, right? You can see retail is definitely declining, which is obvious, right? Because Boingo's moving more into that sort of wholesale DAS space. You can also see advertising is declining, but you can also see their key segments are growing. But also, as you can see here highlighted in orange, you can see, well, hold on a second, guys, like why is the wholesale Wi-Fi declining? Like what, shouldn't it be growing? Like what happened in the last 2 quarters, okay? And the answer to your question is pretty simple. So now there's a couple of things. So the number one thing is, first of all, Boingo ended their Amex partnership, okay? So that probably would have contributed about a sort of, $4, $5, $6, $7 million revenue hit. Not year on year, that's just the total, okay? So once the hit's gone, it's not going to keep going down. Now the other thing is wholesale Wi-Fi, as you can see they've explained in the earnings call, this is the reason why the numbers were down a little bit, okay? But as you can see here, also highlighted in yellow, according to the CFO, this is pretty much the bottom. So they don't see this wholesale Wi-Fi going down anymore, but rather going back up. Quarter 3, quarter 4, most probably quarter 4, but there's some benefit in quarter 3, okay? And again, guys, this is important because this then helps us to project where we think the wholesale Wi-Fi numbers are going to be quarter 3, quarter 4, and for 2020 onwards, okay? So what's revenue going to be and what's EBITDA going to be? So this will then allow us to assign an exit EV to EBITDA multiple. Well, based on their average EBITDA margins, as you can see from quarter 1 2015 all the way through to the most recent quarter, what I've done is I've averaged it out to be about 30%. Okay, so here's the EV to EBITDA margin. Now, I actually think that that's going to be a little bit more on the conservative side, and it should actually be a little bit higher. But again, conservatism is always good, so that we don't get too ahead of ourselves and buy the stock wrong, okay? So this is the first part. So EBITDA margin, I'm going to use 30% for 2019 and 30% for 2020. All right, cool. So now let's work out the actual commercials of the MTA deal and then use that to project what we think the average deal is. Now, if you guys will remember from the last video, the MTA deal is worth 20 times or approximately 20 times as much as an average deal, okay? So if you guys think back to earlier in the video, you'll recall that I've got all the details of the commercials of the MTA deal. For example, the net present value of the total compensation, the term of the deal, the revenue share, what I thought the discount rate was, the year-on-year increase, etc., okay? So this is me putting it all into the spreadsheet. Now, you guys might be wondering, okay, how did he arrive to these numbers? Like, what did you do there, okay? So let me explain. So this is the net present value for part 1 of the deal. This is the net present value for part 2 of the deal. However, if you think back to the commercials, their revenue share is only 25%, okay? What this means is Boingo gets paid 100% and then gives 25% of it away to the MTA for accessing their venues. So as a result, we actually need to increase the net present value that the MTA gets to the full 100%, right? Because this is what Boingo gets paid, which then results in these numbers, okay, as you can see here. And I've adjusted that for each of the different segments, okay? So if you think back to the numbers before in the earlier video, the revenue share doesn't actually increase the dark fiber portions, okay? So what I've done is I've actually worked out what the dark fiber portion will be based on part 2 of the deal, because in part 1 they didn't actually disclose what they thought they would get from the dark fiber piece, but in part 2 they did. They think that the dark fiber piece is worth about $3.5 million to the MTA in terms of the revenue share, okay? And seeing as the minimum annual guarantee is actually 3 times higher in part 2 than part 1 of the deal, I've also adjusted for that. Okay, guys, so as you can see, there are 4 parts to my calculation. Okay, so there's what the whole deal is worth in part 1, what the revenue share for the dark fiber is worth in part 1, what the whole deal is worth in part 2, and what the revenue share for the dark fiber will be in part 2. Okay, now moving to the right side, you can also see that I've adjusted for the CPI inflation 2% year on year. Okay, so what I've done is I've got the whole deal. Then I've obviously divided the net present value, adjusting for the 12% discount rate and all of that stuff to arrive at a year 1 figure of this much per year. Okay, so these things highlighted in the blue boxes is what I believe the deal in each portion is worth to Boingo year one. Okay, now adjusting for the inflation of 2%, then we arrive at this figure. We then tally up the sum total of these four figures, allows us to arrive at the $16.67 million figure. If we think back to here, you'll recall that the build fees are 2/3 of the DAS side of the business, and the recurring fees is 1/3, okay? So that's also going to help us project. According to Boingo, the MTA deal is 20 times the size of an average deal. So as you can see over here, what I've done is I've said, okay, cool, so this is what the MTA deal is worth. This is what they'll get in terms of their build revenue. This is what they'll get in terms of their continued access revenue. And then this is what a normal deal is worth, because a normal deal is 20 times smaller. Now, guys, it's also important to keep in mind at this point that this is the expected, okay? I actually believe that the actual is going to be a lot greater, because it's really hard to project, population growth, usage growth, all of that stuff, okay? So this is all just rough calculations to ink the deal. For conservatism, I'm going to use, the suspected numbers, but I actually believe the actual numbers are going to be a bit more, but again, it's always good to be conservative in our calculations. Alright guys, so now that we know what the MTA deal is worth, what the average deal is worth, what the suspected growth rates will be, and also all of the different segments and roughly what they should do based on historical trends, because nothing has really changed in the business. This will then allow us to then roughly project, as you can see on the spreadsheet here, but more importantly here, the numbers for Boingo, okay? And it's important at this point to note that for their military and multifamily, I've split up military and multifamily to project the revenue changes separately, okay? Because as you guys may remember, they actually acquired Alawit, which is their multifamily piece, as per the previous video. And as a result, that caused this segment revenue to jump. But really, if we split it into two, we'll actually realize that they sort of grow by a little bit more of a modest growth rate, okay? So as you can see, I've split up the military and multifamily revenue. Here's the military revenue over there, and then this is the Alawit revenue over here. And what I've done is I've also applied this portion of the business growing by 20%, because that's what they've said is the target. And obviously it's a young business unit, so we're not really sure whether they'll meet or miss that. But to give management the benefit of the doubt, I've applied 20% to their multifamily side, okay? So as you guys can see, putting all of these numbers together, we've arrived at these numbers over here for Q3 and Q4. And then this will then allow us to arrive at the full year FY19 numbers, and then this will allow us then to arrive at the FY20 numbers. Okay guys, so these numbers assume that Boingo is going to actually take 22 venues live for the year, because if we think back to the previous video and their earnings calls, the CEO has said, look, we believe we will go live with a minimum of 20 venues, but then we've also got 10 venues as potential upside, okay? I've then projected that they'll take 3 venues live in Q3, and then 9 venues live in Q4. And I've also projected that in FY20, they'll actually only see the benefit of the MTA deal, okay? So I've projected that they won't take any other venues live in FY20 apart from the MTA deal. Again, which is very, very unlikely, but again, to be conservative, these numbers are, I guess, appropriate in terms of being conservative, but also being factual, okay? So as a result, you guys can see that we've arrived over here to the following, okay? So we've got the full year revenue for Boingo is 272 and an EBITDA margin of 30%, okay? So that's an EBITDA of this. And then the full year FY20 revenue is 304 million with an EBITDA margin based on 30% of 91.72 million, okay? And so as a result, what I've done is I've now then gone into here and I've projected on the scale 10.5, which is, as you may recall from the start of the video, the 5-year average forward EV to EBITDA multiple, all the way up to sort of 13 and a half, which is the high, okay? But again, to be conservative, I've then compared its current enterprise value to EBITDA versus over here, the 10.5 multiplier. So we'll probably have an upside of 69–70% just based on all of this evidence that we've gathered in terms of my calculations, reverse engineering, etc., okay? But guys, at this point, I think it's really important that we really recap some of the risks and some of the assumptions that I've made in this video, okay? So if you'll think back to the previous video, guys, I believe that this upside will only materialize if they deliver on their Q3, they deliver on their Q4, but more importantly, they guide a good 2020, okay? And just remember, guys, I've made an assumption that the discount rate is 12%, okay? But it could be different, right? So that's why the reverse engineered numbers might not actually be accurate, okay? So this is something important to keep in mind. Also, guys, we also have to keep in mind that no management team is perfect, and obviously they'll have a risk of missing the numbers, okay? Now, if they do miss the numbers, we can as easily see this go back down to, you know, $7 as it'll go up, okay, guys? So always keep this risk in mind. Now, based on my analysis, I don't believe that the risk of management missing guidance is high because, again, if we see their track record for the last 9 quarters, they've only ever missed guidance once, and it wasn't even by that much. As you can see, the miss wasn't a big miss. It was just, you know, a little miss, right? But they've always delivered and beat revenues, in some instances by quite a lot, in some instances by a little bit, and they've always delivered and beat on the EPS apart from one, and again, it's in some instances by quite a lot, and in some instances by quite a bit. Okay, so this gives me confidence that management is unlikely to, you know, I guess, overpromise and underdeliver because they don't have a history of doing that. In fact, they have a history of underpromising, over-delivering. And so as a result, this has given me confidence to do the following, okay? So what I've done is I've put a position ahead of the earnings call. So as you can see, I've put a position in today, ahead of the earnings call, the 5th of November, post-market. And again, guys, just to reiterate, I believe that Q3 will be a small catalyst, and the actual big catalyst is in Q4, okay? But just in case Q3 goes better than expectations, I put the position ahead because I felt that the risk of it going down is a lot lower than the chance of it going up, just based on everything that we've covered, okay, guys? But it's important to do your own research. None of this is financial advice. This is just me doing my research, but it's always important for you guys to, you know, build your own spreadsheets, project your own numbers, and you know, do your own reading. All right, guys, so just to conclude, based on my calculations and in everything we've looked at in this video, I believe there's a good reason to project that Boingo will return to double-digit growth rates in the low teens for FY20, which will then allow the sentiment of the stock to shift and then send the stock back up, resulting in, you know, I believe a sort of 69% odd upside. So guys, I hope you enjoyed the video. Do let me know what you think, and until next time, good luck and happy investing.